Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Business Lunch. I'm Nisha Podar and with me is Manglam Malu. Manglam, good afternoon. Of course, markets are weak today because of various concerns and various factors really impacting our markets, not just the rate hike yesterday by the RBI, but Asian peers as well as global tariff war. So there are many aspects really impacting, but those are the key indices which are 0.5% down today, but it's the mid caps yet again which are outperforming in trades. A lot of impetus also coming in from the exclusion from the ASM list. Some of those counters are doing well, but what's clearly underperforming the overall market is the banking space, Mangla.
Absolutely, and it's Thursday, so that means the Nifty Bank weekly options expiry. So we will watch out for how that pans out in the last hour of trade. More importantly, while we're down, not particularly out yet because we're still holding on to the lows that we saw on Monday as well as Tuesday. So it'll be very interesting to see, given, like you said, the mid-cap index, which is outperforming. Perhaps when that happens, the street believes that maybe the downside is protected. As far as the Asian markets are concerned, all of them lower in trade. Fresh trade wars resurfaced. And as we speak, the European markets actually, they too have opened lower. So we're seeing cuts of in excess of 1% for the German index. The FTSE also in focus because there is the Bank of England monetary policy meet tomorrow. Prime Minister May meets President Macron of France to consider Brexit as well. So there is red across the European screen and there was red in the Asian screen as well. But key focus from last night was the US Federal Reserve, who held their interest rate steady, suggesting another increase is likely at its next meeting. Our CNBC's Steve Leisman reports on the highlights from that Fed meet.
The Fed kept interest rates unchanged at the July-August meeting, but signaled further rate hikes ahead as it upgraded the economic outlook from solid to strong. The benchmark Fed funds rate unchanged at 1 3/4 to 2%, but the Fed said, quote, further gradual increases in the target range for the federal funds rate will be consistent with sustained expansion of economic activity. That is a mouthful of Fed speak for more hikes on the way. And here are those probabilities. Indeed, the market is pricing it that way. September near 90%, December hike near 62%. And then you got to go to June 19 for the next mark above 50%. And that's 61% in June for another quarter point. This is interesting. Greg McBride of Bankrate.com. We'll give a little consumer advice. All signs still point to a September rate hike. Continue paying down variable rate debt, such as credit cards and home equity lines, and refinance adjustable rate debt into fixed rate to insulate yourself from further rate hikes, because there will be more. The Fed added that the labor market has continued to strengthen. Household and business spending were both said to have grown strongly, and inflation remains near its 2% target. Also interesting, what was not said. No mention of whether the Fed thinks strong growth can continue, or the possible economic effects of tariffs, or any response to the president's criticism of its policies. Guys, I'm thinking maybe we get some of those, or part of all those three, in Jackson Hole when the Fed chairman will give his first speech there.
All right, so central banks across the world are ruling the roost as far as markets are concerned, and a September rate hike cannot be ruled out. That's what experts have to say. Let's get in some opinions on what the Fed's decision really means for the markets going forward.
The Fed recognizes the very, very strong growth that the economy is experiencing right now. A lot of it is due to the fiscal stimulus, the deficit finance tax cuts, deficit finance government spending increases, but lots of growth, and the Fed acknowledged that in their statement. Unemployment is low, and it's going to continue to decline. Inflation is very close to the Fed's 2% target. Stock market, other financial markets are strong. So everything suggests that they're going to continue to normalize rates in a very steady way going forward.
The Fed does what the Fed is supposed to do, and for the first time, I think, in the post-crisis, we're seeing what I'd call real data dependency, and the data is strong. Inflation is on the uptick, and you're going to get 2 more rate hikes this year, as we anticipated. The long end of the yield curve, the 10-year Treasury, is not buying the inflation story. And until global central banks move in concert, or inflation really does violate that 2% level on a sustained basis, the yield curve is going to continue to flatten, and that's going to be the quandary the Fed finds itself into early 2019. Until wage growth is material, sustainable, and growing above that 3.5%, maybe 4% level, I don't see inflation getting away from the Fed at this point at all.
By the second half of next year, you've got a bit of a fiscal fade. You don't have any more sugar from tax stimulus. And I believe the 30-year fixed-rate mortgage rate will go above 5%, and that will continue to slow housing, which is already looking a little soft. So yes, it'll slow down in terms of demand, but we've got no supply. They've got to do it, because at that point, I think the unemployment rate will be below 3.5%. We're out of workers. We don't have that much of a productivity surge. So there's no point in pouring more demand into the economy if you can't meet that. And 4 consecutive months now, the number of people entering the country on immigrant visas has fallen. So I actually think the demographic squeeze is getting worse. And if the unemployment rate comes down, then it still means, you've got to be a little forward-looking for the Fed. And if you've got below full employment, you do need to get back to neutral.
All right, Dow futures indicating a cut of almost 100 points, so that is something we will be watching out for. But closer home, there's fresh trouble for Reliance Communications as Ericsson objects to the settlement terms for insolvency case. Ashmit Kumar, our correspondent, joins us on the phone line. Ashmit, take it away.
Right, so what you understand is that the question being asked here is that is there fresh trouble brewing as far as the ARCOM RGO deal is concerned? And the reason for that question essentially is that Ericsson, which was an operational creditor as far as ARCOM is concerned, at least appears to be, on the face of it, appears to be doing a U-turn, appears to be going back on a settlement that had been arrived at between ARCOM as well as Ericsson. Now, keep in mind that Ericsson was claiming outstanding dues of 1,600 crores. After NCLAT mediation, they decided to settle the figure at 550 crore rupees. And on the back of that, Ericsson had agreed to put its plea-seeking insolvency proceedings against ARCOM on hold. Now, what was here before the Apex Court was merely a matter of procedure. Both the parties were only required to express their consent and to close the matter, close the dispute here before the Apex Court. But what lawyers tell us outside the court is that there is an increasing amount of tension between the partners on account of terms of payment of that settlement amount of 550 crore rupees, which is now leading to Ericsson having second thoughts, which in turn begs the question that does this in a manner of speaking put a spanner in the works as far as the ARCOM RGO deal is concerned, because the initial prayer by Ericsson was to stall that entire transaction until the payment is made. So again, and what's important here is that this development comes on the back of the DoD very recently having decided to scrap the spectrum given to ARCOM. That is again another area where SBI-led lenders have approached the DoD to reconsider its decision. So again, multiple fires that need to be put out. As of Ericsson, the case will be heard tomorrow morning by the Apex Court. Back to you.
All right, Ashmit, thanks so much for all those details. So the larger repercussions beyond Reliance Communications is clearly on the lenders to Reliance Communications. And also not to forget, this particular matter has also stalled the mega deal between Reliance Industries, which was to take the assets of Reliance Communications. At the moment, markets have weakened and HDFC Bank has really gone lower in trades today. But we'll slip into a short break at this point. But up next, remember, lots of important earnings today. ONGC, Marico and Indiabulls Housing Finance will report their earnings shortly. We'll get you all the expectations from that one on the other side.
Welcome back. We're slipping close to the low point of the day for our markets itself, still above that 11,260 to 270 zone where we saw some bounce back from in the earlier part of this week. However, currently we're in the lower end of today's trading range. So a couple of stocks which are weighing down on the Nifty. We have L&T, the big boy out there, which is not doing its bit. In fact, it's at the low point as we speak. What is not helping is the fact that the strength in the rupee means the IT stocks, they are weak. So the rupee, as you see, closer to the higher end of today's trading range again, and that means all the IT stocks, if you take a look at perhaps something like a TCS, that one should come up for you. That one too is sitting at the low point of the day. But let's talk about a couple of stocks which are doing well. Non-index large caps, they're doing fairly well. JSW Steel, that one suddenly moved to the high point of the day. And we have Piramal Enterprises from the F&O space. There are rumors, or rather reports, of a rejig in that stable. So that's
so on that note, Manglam, I'd like to point out that Piramal Enterprises has just now clarified, and that notification is going to the exchanges as well. They have said that they're clarifying the news report in certain media publications on a potential demerger of its financial services and the pharmaceutical businesses in this particular current financial year is factually incorrect, and they have denied this particular news report. Those flashes will be coming on screen. So we can go ahead talking about other stocks. Sorry.
All right, let's talk about that. But in fact, there is some confusion over the new axle loading norms, which continues. The CV players are claiming a dip in sales due to uncertainty in the markets. They also want clarity on the new rules. Leading CV makers, in fact, they met the ministry officials and the ARAI chief last week in Pune. Utkarsh Chaturvedi joins in with a roundup of that meeting. Utkarsh, take it away.
Exactly, Manglam. So it was last week that the CV makers, along with the ARAI chief and the ministry officials, met. They wanted some clarification on certain things. Another things which they really spoke to the officials of the ministry were one was that, what they said was that they cannot register the current vehicles with an extra payload. Now, why is that? Because they have to meet certain braking and steering norms of ARAI. And once the payload increases, they will not be able to meet the norms, the braking and steering norms. For that, they'll have to re-engineer their products, and that will take around 6 to 8 months of time, re-engineering the products and then getting the ARAI certification. So really going ahead and increasing the payload at this point of time for all the current vehicles will be difficult for them. Secondly, what they also said was that they needed some certainty about the current vehicles which are on road. What will happen to them if the new axle load norms really apply to them? Then will the current vehicles which are on road will go to the RTOs and will have to re-register themselves, or at the check narcas, the GVWs which they have, suppose a truck is a 37-tonner, will they get a leeway till a 41-tonner and they will not be fined? So there were clarifications which they wanted, and that is precisely the reason. In fact, we spoke to Girish Wagh also yesterday, and today he said that there is some confusion, and you can see the impact on sales as well. In fact, what the ministry officials told all of these CV makers is that in the next 7 to 8 days, you can see some clarity and one more advisory coming out. So all the eyes will be on that advisory, especially with the vehicles which are currently on road.
All right, Utkarsh, thanks so much for getting us all those important details. In fact, Utkarsh, our colleague, also spoke to Girish Wagh, the head of Commercial Vehicles Business Unit at Tata Motors, on the Q1 performance and also the impact of new axle load regulations on the company. Take a look.
Yes, I think Q1 has been very satisfactory for us. We've grown the volumes by 71%, which is more than the industry. So we grew our market share by more than 5%. We've also done very well on EBITDA, as you said, so 11.7% of EBITDA. We've done very well on EBIT, we have done very well on PBT. So all the margins have swung significantly. So it was a very good quarter for us. I think going ahead, we will continue to work with the same passion. There are a few hiccups, if I may say so. So, for example, in medium and heavy commercial vehicles, there is a bit of uncertainty due to the new axle load regulation. But I think we will wait for clarity to emerge. But I think we are fully committed to continue on the same path.
So has there been some impact at this point of time due to the uncertainty regarding axle load norms?
Yes, I think there are quite a few customers who are thinking about the decision to purchase the vehicle. So we have seen some kind of slowdown which is happening in actual retail.
By when do you think there will be a clarity coming in from the government, and what are we really looking at?
I think we'll have to wait and watch.
Last question from my side. Do you think that the planning going ahead of the whole truck industry will really depend on the clarity coming in from here?
I think, see, as far as this particular regulation is concerned, we have to re-engineer, revalidate and recertify our vehicles, and we have already started that work. As far as overall regulatory roadmap is concerned, I think we have already said that it's good to have certainty and visibility on this, and if a proper roadmap has been set, I think the auto industry will align with that.
All right, so that was all about Tata Motors, but take a look at the chart of Piramal Enterprises. That particular stock has really lost a large part of the gains today on the buzz of demerger, which is imminent in this financial year, was the report. But then Piramal Enterprises has clarified, and you heard it first on CNBC TV18, that it's factually incorrect. No such plan in this financial year. That's the key word to remember, and the markets have really given up all the gains that that were taken on that particular counter because of this buzz. All right, let's shift focus to earnings season and earnings in full swing. Three important results actually coming out today. ONGC, Marico, Indiabulls Housing Finance will be reporting their numbers today. We have the entire research team with us to get us all the update on what's expected. Sonal, Abhishek and Manglam obviously is right here. Sonal, you go first.
Thanks a lot for that, Nisha. Well, we are expecting strong numbers from ONGC this time around, and that is because the macros were in favor of the company. The crude prices, they rose around 48% on a YOY basis and 11% sequentially, and that's why we're expecting record high crude realizations for the company this time around. In terms of numbers, revenue growth of around 12% is expected, leading to an EBITDA growth of around 27%. Operating profit margins should see an expansion of around 630 basis points, and profits are expected to increase by around 11%. But the main number that I'll be watching out for is the net crude realizations, expected to be at record levels at $73.6 per barrel. Even the gas realizations are expected to improve both on a YOY and sequential basis. On a YOY basis, expecting a 23% growth and 6% growth on a sequential basis. While subsidy was a major concern, Kotak is expecting a subsidy of around 4,660 crore rupees, and gas volumes are expected to go down, but are expected to go up. But we'll be watching out for those numbers as well. Back to you.
All right, thanks a lot for that. Let's go across to Abhishek now from the NBFC space. Abhishek, Indiabulls Housing Finance will be reporting the numbers. What to expect?
Well, Manglam, the street is anticipating a strong number for Indiabulls Housing Finance. Now, loan growth between 30 to 35% will be positive. Last quarter, it was at 34% plus. Their spreads, that is the difference between their yields on AUM and the cost of funds, have been in the range of 3.2 to 3.25%. Anything above 3.1% will be positive. We need to see how IND-AS impacts its asset quality, which otherwise has largely remained stable below 1%. So anything below 0.9% will be positive. Other housing finance companies have been stressing on the fact that affordable housing segment is seeing a stress in terms of the supply side, and the cost of funds have also increased due to liquidity crunch and the rise in interest rates. Our polls suggest NI growth of 30% plus, while net profit to grow at 26% plus. Back to you.
All right, thanks Abhishek for that. And Manglam, let's focus on Marico as well. That's coming out with results today. What is Street expecting?
Absolutely. So Marico, you know, like all FMCG companies, stock is at a record high ahead of numbers. The Street is expecting a good set, aided by a low base and some pricing growth that the company has taken. The good set would mean the top line growth would come at around 18%. Now, the top line growth at 18% would necessarily not percolate down to the bottom line, because the EBITDA is likely to grow at just about 12.5%. That means the margin declines by about 100 basis points. 18.5% thereabout is what we are expecting. Add to that, in terms of volumes, the domestic volume growth is seen to be anywhere around 10 to 11%. That comes on a low base, and the remainder of that top line growth will come in on the back of price hikes that the company has taken in its parachute portfolio. The price hike, of course, has been taken to negate the surge that there has been in the copra prices as well as Cardi oil prices, which the company uses to sell and manufacture Saffola itself. In terms of individual products, just watch out for a 10% plus growth, which will come by in a parachute. That's what the Street is expecting. Value-added portfolios supposed to do very well. Saffola is the pain point for the company, and youth portfolio growing anywhere between 6 to 8%. All right, with that, we'll step into a short break. On the other side, Telangana misses the August 1 state deadline to roll out RERA. Details when we come back.
Welcome back. You're watching Business Lunch. Now, an impressive quarter for the general insurance subsidiary of State Bank of India. And this is, remember, ahead of the company's much-awaited initial public offering. Now, the company's gross premium crossed the 1,000 crore rupees mark, as well as the profits really doubled for the first quarter of FY19. Here's a slice of the interaction that CNBC TV18 had with Mr. Pushan Mahapatra, who's the MD and CEO of the company.
As against a GWP of 647 crores last year, at the end of June 17, this year we closed the first quarter at a GWP of 1,011 crores.
Okay.
1,000 crores is also a very important landmark, because this is the first time that we have closed the first quarter with 1,000 plus GWP, which translates into about a 52% growth.
Right.
Similarly, on the net profit side, from about 50 crores of net profit before tax last time, same period last year, we have closed the quarter with a profit figure of 113 crores.
So give us some sort of an outlook as far as FY19 is concerned. What is the target as far as premium growth is concerned that you're targeting for the financial year 19?
Oh, well, 52% every quarter may not be possible because there are seasonal elements to it.
Would you call this a one-off as far as the combined ratio performance is concerned, and there could be some fluctuation to it going forward, or do you think this is sustainable as far as the overall financial performance is concerned to the combined ratio?
Like, see, even 99 is a marginal this thing.
Right.
So there would be certain quarters that we could slip percentage here and there.
All right, some flashes on your screen. Telangana misses August 1 state deadline to roll out for RERA. Nitya Balakrishnan joins us on the phone line with more. Nitya.
Absolutely. In fact, 1st of July was the initial deadline for implementation of RERA in India's youngest state. That was later postponed to 1st of August. But looks like the state needs at least another 15 to 20 days to actually go ahead and roll out RERA. What we're picking up from senior government sources is that there are final touches to the portal that's currently underway, as well as the infrastructure for the office that has to be fine-tuned, which is why we're seeing no registrations under RERA, of course, till that official rollout takes place, and we're expecting that by the end of August. What we're also picking up is that they want a foolproof grievance redressal and registration mechanism, which is why they're taking their time. Remember, they have studied various other state models, especially Maharashtra, which seems to be doing really well, and they want to implement RERA in Telangana along similar lines. Developers are not overtly concerned, indicating that they've gone ahead and begun construction of new projects in the good faith that the government will go ahead and implement RERA by September. But as far as the deadline is concerned, they did set an August 1st deadline, and they seem to have missed that as well.
All right, that was the biggest actually policy reform in the real estate sector, RERA, and those are the details coming in. Thanks, Nitya, for that. Ramco Cement's Q1 numbers are flashing on your screens. 125 crore rupees as far as net profits is concerned. EBITDA at 250 crore rupees, and it is in line with the CNBC TV18's poll, and that's profit figure for you. Fairly in line, slightly lower than what CNBC TV18 was expecting. So that's the stock for you. But with that, we'll wrap it on Business Lunch, and Midcap Radar will take all that action from markets and earnings forward. Stay tuned to CNBC TV18.